Is Brent heading to $90 this week? The geopolitical risks are exploding, and the supply side is under severe threat. I'm breaking down the exact levels to watch for the next huge move in oil. The full swing trade setup is inside. Head to the Alpha Market Meridian channel to get the full analysis before the market opens. See you there. This is Alpha Market Meridian, and we are now live with the analysis that matters. We are looking at the crude oil complex, and let me be clear right from the start. The narrative has changed. Over the last 72 hours, the interplay between Brent and WTI has taken on a distinct geopolitical flavor that we haven't felt since the early days of the Ukraine conflict. I want you to shift your focus away from the simple supply-demand balancing act and look at what is happening in the Middle East and specifically in the Strait of Hormuz. I have seen this exact type of market divergence before, back in 2019 when tankers were attacked off the coast of the UAE. Back then, the market's initial reaction was a muted rally until a key trigger occurred, and that's when things escalated violently. And that is the critical warning for this week. The markets are currently pricing in a significant risk premium. Brent has broken above $85, settling at 85.81, and WTI is holding near its 2026 highs at 81.15. This is a market that is starting to sweat. The major driver is not just the output of OPEC, but the escalating tensions along a critical shipping lane. That moves about 20% of the world's crude supply. Welcome back to Alpha Market Meridian. I am your host, and I am here to cut through the noise and give you the trading edge that if you are long or short crude, your position is now at the mercy of the geopolitical heartbeat of the oil market. This is the kind of week where a single headline can send price vaulting higher or crashing lower, and your job is to be positioned on the right side of the pivot. This is the analysis for the week of August 26, 2026. And before we get into the numbers, I want to highlight the overarching theme. The market is currently trapped between two opposing forces. On one side, we have the reality of a potential and imminent supply disruption. On the other side, we have the fear of a global economic slowdown that is suppressing demand and could completely erase the supply risks. This creates a volatile, reactive environment, and it is the most dangerous and potentially profitable setup of the quarter. We are going to break down the levels, the catalysts, and the specific strategies to navigate this. My bias on both Brent and WTI is heavily bullish, but with a specific condition of invalidation. I am looking for a continued grind higher, but the invalidation level is clear. If Brent drops below 84.20 and holds there, my bullish bias is dead. The same goes for WTI. If WTI breaks below 79.80 convincingly, the geopolitical risk premium is completely priced out, and we are switching to a bearish or neutral stance. But as it stands, with the market holding these key levels, I am buying dips. The market structure is unequivocally bullish on the weekly charts, and our analysis suggests that the path of least resistance is to the upside. Let's start with the weekly chart. The trend on Brent is firmly bullish. The MA50 on the weekly chart is sitting at 82.10. While the MA200 is significantly lower at 76.50. This is a classic bull market formation where the shorter-term moving average is above the longer-term, and both are sloping upwards. For WTI, it's a similar story. The weekly MA50 is at 78.20 and the MA200 is at 72.50. Price has found a solid base above these levels. This is the foundational structure that gives me confidence in the bullish bias. I see the overall trajectory as higher. What stands out to me here is not just the moving averages, but the interaction of the RSI. Brent's RSI on the weekly chart is at 63, which is showing strong momentum but not yet in overbought territory. This suggests there is still room for another leg up. On the WTI, the RSI is at 66. Giving a similar bullish signal. Moving to the daily chart, we need to look at the immediate price action. On Brent, yesterday's candlestick closed as a bullish engulfing pattern, which is a strong continuation signal. The daily pivot point is calculated at 85.12. We closed above it, which is supportive of our long bias. The daily MA5 is at 85.20 and acts as immediate dynamic support. as long as we hold above. This, the short-term momentum is with the bulls. For WTI, the daily chart shows a similar recovery. The price broke out of a tight consolidation range yesterday and is now trying to establish a new trading range. The daily MA10 for WTI is at 80.90 and is acting as support. I am watching the 81.50 level, which is a previous swing high. A break above that confirms the breakout and opens the door for a test of $83. Now, let's dive into the 4-hour structure because this is where the actionable technicals are. On the 4-hour chart for Brent, the MACD is showing a bullish crossover. The MACD line has crossed above the signal line, which is a classic buy signal. The ATR, or average true range, on the 4-hour Brent chart is 1.25, which tells me we are in a relatively high volatility environment. When the ATR is this high, you need to widen your stop losses to avoid being stopped out on volatility spikes. For WTI, the 4-hour chart shows a strong ADX reading of 35. This is above the 25 threshold, indicating a strong trend. The Williams %R is at -15, which is approaching overbought, so I would be cautious about chasing a move here. It reinforces the idea that the best entry is on a dip rather than a breakout. Now, let's zoom into the 1-hour charts for the immediate scalp setups. Brent is currently consolidating just below the $86 psychological resistance. The stochastic on the 1-hour chart is showing a bearish crossover, suggesting a potential short-term pullback. I am looking for a pullback to the 85.50 support to get longed on the 1-hour chart for WTI. The RSI is at 60. This is neutral but the slope is flattening out. The CCI is at 150, which is starting to show some bearish divergence compared to the price. This is the telltale sign of a market that is losing momentum. It is a classic retail trap pattern where the price makes a new high but the CCI fails to follow. This was the exact same pattern I saw in August 2022, just before that massive squeeze to the upside. This divergence is a warning sign. It doesn't mean we short immediately. It means we don't buy breakouts. We buy dips. The market is struggling to push higher, and if it gets a negative news headline, the sell-off could be fast and deep. Fundamentally, the oil market is a two-part story. The first and most immediate story is geopolitical. The headlines over the past 24 hours are filled with chatter about increased naval presence in the Persian Gulf and rising tensions with Iran. There is a growing consensus among geopolitical analysts that a targeted strike on a tanker or oil facility is a distinct possibility, and the market is starting to price that in. The second story is the demand side. We are seeing weak manufacturing data out of Europe and the United States, which typically correlates with lower oil demand. But this is being offset by a surprise easing of monetary policy from the People's Bank of China. I believe the market is underestimating the stimulative effect of this Chinese easing. I think the smart money is watching this very closely. The easing will likely lead to a surge in infrastructure spending and industrial activity over the next quarter, which is a huge boost for oil demand. Upcoming this week, the key events are the weekly EIA crude oil inventories report on Wednesday and the release of the core PCE price index from the US on Friday. The EIA report is the key fundamental event for the week. If we see a large drawdown in inventories, it could trigger the next leg higher. The PCE data on Friday is important for the dollar. A higher PCE means a stronger dollar, which could weigh on oil prices, but it also means the Federal Reserve will be forced to hold rates higher for longer, which could tip the economy into a recession. It is a delicate balance that I have developed a proprietary observation over my career about the relationship between the 10-year yield and oil. When the 10-year yield is rising, it tends to exert downward pressure on oil, but when it breaks lower, it acts as a safety valve for commodities. Right now, we are seeing the yield retreat, which is one of the key signals I am using to stay long. Alright, let's get into the specific trade setups for both Brent and WTI. We have 2 scalping setups and 1 swing trade. Scalp setup 1, Brent. By the dip, this is a high probability scalp for the next 24 hours. Entry zone, from 85.40 to 85.50 stop loss. At 84.75 take profit 1. At 86.20 take profit 2. at 86.85 risk reward. Approximately 1 to 1.5 to 1 to 2.2 invalidation. A break and 4-hour close below 84.75 scalp setup 2. WTI. By the dip, this mirrors the Brent setup but with WTI specific levels. Entry zone. From 80.70 to 80.85 stop loss. At 79.90 take profit 1. At 81.80 take profit 2. At 82.50 risk reward. Approximately 1 to 1.5 to 1 to 2 invalidation. A break below 79.90 swing trade setup 1. Brent. Swing long, this is for the next 3 to 5 days. Entry zone. From 84.80 to 85.20 on a pullback stop loss. At 83.80 take profit 1. At 87.50 take profit 2. At 89.00 risk reward. Approximately 1 to 2 to 1 to 3.5 invalidation. A daily close below 83.80 swing trade setup 2. WTI. Swing long entry zone. From 80.10 to 80.40 stop loss. At 79.00 take profit 1. At 82.50 take profit 2. At 84.00 risk reward. Approximately 1 to 2 to 1 to 3.5 invalidation. A daily close below 79.00. Now, if you like these setups, make sure you like this video and subscribe to the channel to help the algorithm. Let's talk about managing the risk on these trades. Because we are in a high volatility environment driven by geopolitics, you need to be very careful with position sizing. I will not take a large position going into an unpredictable event. I am scaling into these positions. My personal rule is to risk no more than 2% of my total account capital on any single swing trade, and no more than 1% on a scalp. I remember a time back in 2020 when I got caught on the wrong side of an OPEC announcement. I was overleveraged, and it wiped out a month's worth of profits in a single session. Since then, I have never allowed myself to be caught off guard. You must be disciplined. To close this session. The key level to watch is $86 on Brent and $82 on WTI. A break and hold above these levels signals a continuation of the bullish momentum. A failure to do so could lead to a quick retest of the supports we discussed. This has been your weekly analysis for Brent crude and WTI crude. Remember, the outcome is unknown, but your process is known. I will be back on Friday to review how these levels played out and to reset for next week. In the meantime, if you want to dig deeper into the energy sector, check out our analysis on US 100 and the SPX, which we linked in the description below. The whole team at Trade Meridian Decoded is dedicated to giving you the highest quality financial analysis. Thank you for watching. We will see you on the next one.